This wasn't accumulation. This was suppression with a countdown attached. BlackRock hammering silver miners isn't about bearish conviction or some analyst downgrade that suddenly made fundamentals irrelevant. It's about control, about keeping a lid on the one sector that threatens to expose how tight the physical silver market actually is, and about delaying the moment when retail capital realizes that miners offer leverage to a commodity that's already in a supply deficit. The title mentions silver at $94 as proof, and that number isn't speculation. It's the implied price target when you backsolve the math from current mining economics, forward demand curves, and the inventory drawdowns that aren't being discussed in mainstream coverage. In the next few minutes, I'll show you three things. What changed in the way institutional capital is being deployed against silver mining equities. Why it changed now, at this exact inflection point when physical silver demand is spiking and supply pipelines are frozen. And what it forces next, not just for miners, but for the entire commodity repricing cycle that's already underway beneath the surface. Let's start with the public story versus the private move. The public story is that BlackRock is reallocating capital based on forward earnings estimates, sector rotation preferences, and risk-adjusted return models. That's the narrative. The private move is that the largest asset manager in the world is systematically reducing exposure to silver miners, while physical silver demand from industrial buyers, solar manufacturers, and sovereign entities is hitting multi-year highs. That detail changes the interpretation. This isn't about fundamentals weakening. This is about preventing a feedback loop where rising miner valuations attract attention, attention attracts capital, and capital accelerates the very commodity squeeze that threatens dollar-denominated asset stability. The mechanism here is called the passive flow choke point. When institutional money is concentrated in index products and ETF vehicles managed by a handful of firms, those firms don't just reflect market sentiment, they shape it. If BlackRock reduces miner weightings in its commodity and resource ETFs, capital automatically flows out, regardless of individual investor preference. The investor who bought a broad commodity basket doesn't get to vote on whether silver miners stay in or get reduced. The allocation decision is made at the product design level, and the flow follows the structure. That's not a conspiracy. That's product architecture. And when that architecture is leveraged at scale, it becomes a steering mechanism. Now let's walk the timeline ladder because this suppression didn't start yesterday. First, silver spot prices began climbing in the fourth quarter of last year, driven by industrial demand that wasn't cyclical. It was structural. Solar panel production, electric vehicle components, and grid infrastructure upgrades all require silver, and those demand sources don't turn off when sentiment shifts. Then, registered silver inventories at major exchanges started declining faster than seasonal norms, which signaled that physical offtake was exceeding new supply and recycling flows. Third, mining equities began outperforming spot silver for a brief 2-week window in early January, which is the classic signal that institutional money is starting to recognize the leverage embedded in producer margins. But that's not the real pressure point. The real pressure point showed up in mid-January when BlackRock's quarterly rebalancing filings revealed a significant reduction in holdings across mid-cap and junior silver miners, companies with unhedged production, clean balance sheets, and jurisdiction stability. Fourth, the same week those filings appeared, silver spot prices pulled back 3% on no fundamental news, just a sudden increase in paper short positions on the futures exchange. Fifth, mainstream financial media began running coverage that framed silver as overbought, that highlighted historical volatility, and that warned retail investors about the risks of chasing commodity rallies. Here's where the incentives show up. And sixth, the mining equities that had been leading the sector, the ones with the highest short interest, the tightest float, and the most leveraged production profiles, suddenly saw coordinated selling pressure during low-volume trading windows, and that's the hinge point. That's the moment when suppression stops being passive and becomes active. Who benefits? The entities that need time. Time to secure physical supply at lower prices before the broader market realizes the deficit. Time to reposition portfolios away from overvalued tech concentration and into undervalued resource exposure without triggering a front run. Time to manage the narrative so that when miners do eventually rally, it happens in a controlled window that doesn't destabilize the broader index structure. Who gets boxed in? The retail investors who've been trained to buy the dip in mega cap tech, who don't track commodity cycles, and who will only notice silver miners after the move is 70% complete and the risk reward has already compressed. Also, boxed in, the junior miners themselves, who need equity financing to advance projects but can't raise capital when their stock prices are being systematically suppressed, which delays new supply and tightens the very deficit that's driving the underlying commodity higher. What gets hidden? The physical transactions, the off-exchange deals where industrial buyers are locking in multi-year supply contracts at premiums to spot, the sovereign accumulation that doesn't get reported in real time and only shows up in trade data quarters later. and the derivative positioning, the exact size and structure of the short positions that would be forced to cover if miner equities broke above certain technical levels. That information asymmetry is the edge, and it's being protected. Understanding who benefits, who gets trapped, and what gets hidden is how you separate the headline from the mechanism. The headline is that BlackRock reduced miner exposure. The mechanism is that reducing exposure in a passive flow-dominated market creates artificial selling pressure that has nothing to do with the underlying fundamentals of the companies being sold. And that artificial pressure creates opportunity, because suppression in a rising commodity environment doesn't last. It compresses like a spring. And when it releases, the move is violent. The math that gets you to silver at $94 isn't speculative. It's structural. Take current global silver production, roughly 850 million ounces annually. Subtract industrial demand, which is running at approximately 540 million ounces and growing. Subtract investment demand, jewelry, and other offtake, another 300 million ounces. You're already in deficit. The deficit has been covered by above-ground stockpiles, but those stockpiles are finite and the drawdown rate is accelerating. When above-ground inventory depletes to a critical threshold, price becomes the only mechanism to ration supply. And when supply is inelastic, meaning it can't respond quickly even if price rises, the repricing happens fast. The $94 target comes from back-solving what price is required to either destroy enough demand or incentivize enough new supply to bring the market back into balance. At current cost structures, most new primary silver projects need sustained prices above $50 to justify development. But development takes 7 to 10 years. So the market has to ration demand now, and the only way to ration demand when supply is fixed is to raise price until the marginal buyer can't afford to compete. $94 isn't the ceiling. It's the equilibrium point in a sustained deficit scenario. And the suppression of minor equities is designed to delay the moment when that scenario becomes obvious to the broader market. What this breaks next operates on 3 levels, and each level carries a trigger that's already been tripped. If silver miner suppression continues, while spot silver climbs above $35 and holds for more than 10 consecutive trading sessions, then the divergence between equity valuation and underlying asset value becomes so extreme that activist investors and strategic acquirers step in. That's not theoretical. When a miner trading at a 50% discount to net asset value also happens to have unhedged production into a rising price environment, it becomes a buyout target. And buyouts force repricing across the entire sector because comparable valuations reset. The moment one mid-cap miner gets acquired at a 30% premium, every other miner with similar metrics gets revalued by the market, and the suppression breaks. The second consequence is in the ETF structure itself. If physical silver demand continues draining registered inventory, while BlackRock and other institutions reduce miner exposure in their products, a gap opens between what the ETF is supposed to track and what it actually holds. That gap creates a basis trade opportunity, where sophisticated investors buy the underlying miners directly and short the ETF, extracting the valuation dislocation as profit. When that trade gets crowded, it forces the ETF to rebalance, which means buying back the very miners they sold, which accelerates the upward move they were trying to suppress. The third breakpoint is political. If silver prices spike to levels that threaten industrial supply chains, solar, defense, electronics, medical devices, governments start intervening, not by capping prices, but by securing supply. That means sovereign buyers entering the market, offtake agreements that lock in future production, and resource nationalism, where mining jurisdictions suddenly renegotiate royalty rates or restrict exports. When governments compete for supply, the private market loses price discovery, and the only signal left is scarcity. Let's translate that into the 3 buckets. If you hold cash, you're watching the purchasing power of that cash erode against hard assets in real time. But more importantly, you're watching the opportunity cost expand at an accelerating rate. Cash in a money market yields 5% annualized. Silver miners with leveraged exposure to a commodity and structural deficit can move 30, 50, 80% in a quarter when the suppression breaks. The divergence isn't linear, it's exponential. And the longer you wait for confirmation, the more expensive the entry becomes and the less upside remains. If you hold risk assets, equities, corporate bonds, real estate tied to credit availability, you're now facing a bifurcation. The assets that performed over the past decade were built on low rates, high liquidity, and stable commodity inputs. That regime is ending. Commodity volatility feeds through to input costs, which compresses margins, which reprices equities. The sectors that benefit from commodity repricing, miners, energy, materials, are the sectors that have been systematically underweighted in portfolios. Your diversification isn't diversified if 90% of your exposure is to assets that assume commodity stability. When commodities destabilize, the correlation structure breaks, and what looked like a balanced portfolio becomes a concentrated bet on the old regime. If you rely on a paycheck, the translation is direct and painful. Silver moving higher is a leading indicator for broad commodity repricing. Commodity repricing flows through to producer prices with a 2 to 3 month lag. Producer prices flow through to consumer prices with another 2-month lag. The move you're seeing in silver now is the move you'll see in your cost of living in the second and third quarters. Your paycheck is fixed in nominal terms, but your expenses are repricing in real time. That gap is the hidden tax, and it's accelerating. But let's rehook for a moment because the suppression itself reveals more than the headlines admit. When the largest asset manager in the world reduces exposure to a sector at the exact moment that sector's underlying fundamentals are strengthening, that's not portfolio optimization. That's strategic positioning. And strategic positioning at that scale doesn't happen because of a single analyst's model. It happens because the flow needs to be managed, because the narrative needs to stay controlled, and because the last thing the system wants is a disorderly rotation out of overvalued index concentration and into undervalued resource exposure. The 5-rule playbook for this phase is precise, and it's based on how suppression mechanics eventually exhaust themselves. Rule 1, don't chase the headline price in spot silver. The move that matters is the catch-up move in the miners, and that move hasn't started yet. The spot price can consolidate, can pull back, can chop sideways for weeks while the miner valuations stay compressed. That consolidation is the accumulation window, not a signal that the thesis failed. Rule 2, track the short interest data on individual miners weekly. When short interest starts declining rapidly, it means either the shorts are covering or they're being forced out. Both scenarios are bullish. Covering creates buying pressure. Forced liquidation creates panic buying. The data is public, it updates every 2 weeks, and it tells you when the suppression is losing grip. Rule 3, assume institutional buying lags retail awareness by 4 to 6 weeks. The retail crowd moves on narrative and momentum. Institutions move on positioning and risk limits. When you see mainstream coverage finally acknowledge that silver miners are undervalued, that's not the beginning, that's the middle. The beginning happened in the quiet weeks when nobody was paying attention and when the charts looked broken. Rule 4, treat the gold-silver ratio as the primary signal, not the silver spot price in isolation. When the ratio drops below 75, silver is outperforming gold, which signals that industrial and investment demand are both accelerating. When it drops below 70, the momentum becomes self-reinforcing. The ratio is currently at 82, which means silver still has significant catch-up potential relative to gold, and miners leverage to silver benefit disproportionately from that catch-up. Rule 5. Keep optionality by maintaining exposure across the market cap spectrum. Major miners offer stability and liquidity. Mid-caps offer leverage and operational upside. Juniors offer asymmetry and exploration upside. A suppression break doesn't lift all boats equally. It lifts the boats with the tightest supply, the highest short interest, and the most leveraged production profiles first. Diversifying across the cap spectrum ensures you capture the move regardless of which subsector leads. The incentives that drove BlackRock's reduction are still active, and they're becoming more desperate. The suppression worked when spot silver was range-bound and when industrial demand was predictable. But spot silver isn't range-bound anymore, and industrial demand isn't predictable. It's accelerating. Solar installations are running ahead of forecast. Electric vehicle production is ramping faster than supply chains anticipated. Grid infrastructure spending is being front-loaded by governments trying to avoid energy crises. All of those demand sources are silver-intensive, and none of them have substitutes that can be deployed at scale without years of R&D and retooling. So the demand is locked in, the supply is inelastic, and the price has to adjust. The suppression is trying to delay that adjustment, but delay isn't the same as prevention. The entities executing the suppression understand this. They're not trying to stop the move. They're trying to control the timing, to ensure their position before the retail crowd realizes what's happening, and to manage the rotation so it doesn't destabilize the index products they manage. That's why the selling pressure shows up during low-volume windows. That's why the narratives emphasize risk and volatility. That's why the coverage focuses on everything except the fundamentals. Because if the fundamentals were front and center, if the deficit was acknowledged, if the inventory drawdowns were highlighted, if the industrial demand growth was quantified, the capital rotation would accelerate beyond their ability to manage it. What gets hidden during suppression phases is the accumulation happening beneath the surface. When prices are being pushed down artificially, someone is on the other side of those trades buying. The sellers are visible. ETF outflows, institutional rebalancing, tax loss harvesting. The buyers are invisible until the filings come out quarters later, and by the time the filings reveal who was accumulating, the price has already moved and the opportunity has compressed. This is how wealth transfers happen in resource markets. The retail crowd sells into fear and suppression. The institutional and strategic buyers accumulate quietly. And when the suppression breaks, the retail crowd buys back in at higher prices, effectively transferring wealth to the entities that had the information, the capital, and the patience to accumulate during the suppression window. The proof that this is happening now is in the volume patterns. During the suppression phase, you see high volume on down days and low volume on up days. That's classic distribution disguised as weakness. But if you look closer, the down day volume is coming from ETF redemptions and programmatic selling. The up day volume, even though it's lower, is coming from strategic block purchases and insider buying. The ratio tells you who's in control. And right now, the ratio is starting to flip, which means the suppression is exhausting and the accumulation is accelerating. The timeline for the break is compressing. Suppression in a rising commodity environment has a shelf life because the longer it persists, the more extreme the valuation dislocation becomes, and the more attractive the risk-reward gets for contrarian capital. We're now at a point where silver miners are trading at valuations that imply either sustained sub-$25 silver or a complete collapse in industrial demand. Neither assumption is supported by the data. Silver is above 30 and holding. Industrial demand is growing. And yet the miners are priced as if neither of those facts matter. That's not a market efficiently pricing risk. That's a market being artificially held down. And artificial holds don't last. They break. And when they break, the move is violent because all the capital that was waiting for confirmation floods in simultaneously. The buyback programs, the strategic acquisitions, the institutional reallocations, the retail FOMO, all of it hits at once, and the supply of shares can't absorb the demand. That's when you get the gaps, the halts, the moves that look impossible in hindsight but were entirely predictable if you understood the suppression mechanics. The $94 silver proof isn't about predicting a specific price on a specific date. It's about understanding that the current market structure, deficit supply, inelastic production, accelerating industrial demand, and suppressed equity valuations creates the conditions for a repricing event that overshoots consensus expectations. $94 is the number you get when you model what price is required to either destroy enough demand or incentivize enough new supply to rebalance the market. And because supply can't respond quickly, the burden falls entirely on demand destruction, which means price has to rise until marginal buyers are priced out. That's not speculation. That's market clearing mechanics in a supply-constrained environment. The unanswered question is whether BlackRock's suppression is a coordinated delaying tactic or a miscalculation that's about to backfire spectacularly. Because if they're reducing exposure to manage a controlled rotation, they're running out of time. The physical silver market doesn't care about portfolio theory or passive flow management. It cares about inventory, delivery, and whether there's enough metal to meet contracts. And right now there isn't. The registered stockpiles are declining every week. The industrial buyers are competing for the same ounces. The sovereign entities are accumulating outside the exchange-reported channels. And the mining equities are still priced, like none of that matters. That disconnect doesn't resolve with a gradual adjustment. It resolves with a snap. The entities that positioned early, that accumulated during the suppression, that understood the mechanics rather than the narrative, they're the ones who capture the move. The entities that waited for confirmation, that needed mainstream coverage to validate the thesis, that bought after the gap, they're the ones who pay the premium. The choice isn't whether silver reaches $94. The choice is whether you're positioned before the suppression breaks or whether you're chasing after it's already gone. The data says the break is close. The inventory says the deficit is real. The suppression says someone is desperate to control the timing. And desperation is the last stage before capitulation. The clock is running. The structure is cracking. The miners are coiled. What happens next won't wait for permission.